Welcome to Talk Tickers, your deep dive into the world of earnings calls. We're here to cut through the noise and get to what really matters. Today, we're tackling TD Bank Group's Q3 2025 conference call. Now, you might have seen some headlines, maybe expected a bit of a party atmosphere given some numbers. But what's really interesting is, despite those strong figures, the market reaction was, well, cautious. Shares actually went down. This isn't just a simple good news, bad news thing. It feels like a deeper story about investors looking at future commitments versus today's strengths.
That's exactly it. It was a fascinating split, really. On one hand, you had these strong beats, top line, bottom line numbers that usually get investors pretty excited. But when you dig in, when you do that real deep dive, you uncover these significant ongoing challenges and some pretty substantial future spending commitments, too. It seemed like those just overshadowed the good stuff, like having a great looking car, but knowing there's a massive engine repair bill coming due. People focus on the bill. So yeah, we're going to unpack what drove that tension for TD.
That's a great way to put it. Okay, let's start with those headline numbers, because honestly, they were pretty impressive on the surface. For Q3 2025, TD delivered an adjusted earnings per share of C$2.20. That beat the C$2.05 consensus by a solid C$15, and adjusted total revenue, also strong, came in at C$15.6 billion, beating projections, and that's up a robust 9.6% year over year, numbers you usually celebrate.
Absolutely. And look at credit, the provision for credit losses, PCL, the money set aside for potential bad loans, $971 million. That was quite a bit better than the $1.21 billion analysts were expecting. Suggests loans are performing well right now. Plus, they kept a very healthy common equity tier 1 ratio, CET1, at 14.8%.
Yeah.
That's a key measure of bank strength. It's capital buffer. So yeah, purely on financial performance, look very solid, very robust results.
Right.
But like we said, despite these seemingly great beats, the market's reaction on August 28th was just surprisingly muted, cautious even. We saw that notable share price decline. It strongly suggests investors were focused on something else, something lurking behind those raw figures. So what was that hidden signal? What was the something that poured cold water on the good news?
Okay, so we've seen the strong top line, the successes in certain areas, but now let's get into the part of the story that's really got investors worried, the elephant in the room. But before we do that, let's give credit where it's due. Canada Personal and Commercial Banking, absolutely fantastic quarter. Record revenue, record earnings, deposits, loan volumes. Revenue up 5% year over year. And get this, card acquisitions hit their highest level in almost a decade. That's pretty remarkable.
It really is remarkable. It just underscores the fundamental strength, the resilience of their core Canadian business. Mm-hmm. It's not just riding a good market. It points to, effective strategy, maybe strong digital tools, really knowing their Canadian customers. They're clearly doing things right north of the border.
And it wasn't only Canada shining. Wealth management and insurance also posted record earnings and assets. Net income there jumped a huge 63% year over year. Then you had wholesale banking also strong, clearing $2 billion in revenue for the third quarter running. What's driving that kind of performance there?
Well, in wealth, a jump like that often comes from a mix of things, markets helping assets grow, sure, but also bringing in new clients effectively. Good execution. For wholesale, hitting over $2 billion 3 quarters straight suggests broad-based strength, probably markets normalizing a bit, maybe more activity in capital markets, advisory work picking up. So yeah, across these core areas, you're seeing some serious positive momentum.
So pulling it all together, the bank actually reported positive operating leverage for the quarter. And for anyone listening, that's a really key metric. It means revenue growth outpaced expense growth. That's a sign of efficiency, a very healthy trend, especially for a bank. And here's a big but. There was a significant drag on those otherwise great overall results. It came from the U.S. retail segment. Adjusted net income there was down a steep 18% year over year. That's a big dent in an otherwise strong picture.
And that points directly, inescapably, to the ongoing and, let's be frank, very expensive anti-money laundering, the AML remediation program. We're talking about roughly US $500 million in pre-tax spending just on remediation and controls expected for fiscal 2025. And they specifically said similar levels are projected for 2026. This isn't just paying a fine for past mistakes. This is a deep multi-year overhaul. Systems, governance, processes in the US. It's major surgery on a core part of the business while it's still running. Complex, expensive, and absolutely necessary. But the market's clearly fixated on the cost and the duration of this.
And understanding that timeline is so important because it's definitely not a quick fix. Management said they expect to finish the majority of the management remediation actions by the end of calendar 2025. But crucially, the significant work, like making sure the fixes are sustainable, the testing phases, That continues well into 2026 and even 2027. This isn't a sprint, it's looking like a marathon, definitely, with a long tail on the spending. The costs won't just disappear next year.
Yeah, and if you connect that to the bigger picture, they're also working hard on restructuring the U.S. balance sheet, partly to offset these challenges. They finished repositioning an investment portfolio selling about U.S. $25 billion notional. That's the face value, remember?
Yeah.
It resulted in an upfront pre-tax loss of U.S. $1.3 billion. Sounds bad, but strategically, they project this move will actually generate a benefit of around U.S. $500 million pre-tax in net income in fiscal 2025. So it's a calculated move to optimize assets for future returns despite the initial hit.
Right. Plus, they hit their target of reducing assets in U.S. retail by 10%. That brought total assets down by U.S. $17 billion to U.S. $386 billion. And there's more planned. Another U.S. $18 billion in identified loan reductions are slated through most of 2026. They're aiming for what management called a fighting weight size for the U.S. business. The idea is this should eventually boost the U.S. retail return on equity, which, by the way, is already up 140 basis points since Q4 2024. That's a 1.4% improvement, not insignificant.
But it raises a key question, doesn't it? While they're shedding some assets and dealing with these huge AML costs, how are they actually investing for future growth? You can't just cut your way to success.
Well, they did highlight some things. The launch of TDAI Prism, that's an AI tool for client personalization, and also a virtual AI assistant in TD Securities to help with research. So these are forward-looking investments happening alongside the cleanup. Shows they're trying to keep an eye on the future, even with these headwinds. And don't forget capital. That CET1 ratio is strong. 14.8%, boosted significantly by selling their Schwab stake back in February 2025. They're also actively buying back shares. They've repurchased 46 million shares for over $4 billion already. That's nearly halfway through their $8 billion target. Usually that kind of buyback signals management confidence, a commitment to shareholder returns. So knowing all that, how do you reconcile it? These strong operational beats in some areas, but then the market's obvious skepticism. What's the single biggest thing, in your view, that investors are hung up on, making them look past the positives?
It's that clear split, isn't it? Management sounds quite bullish, quite positive about the core businesses, Canada, wealth, wholesale, but the market sentiment is just cautious. The number one concern, without a doubt, is that ongoing AML overhang and the huge expense drag it creates, especially in U.S. retail. Even with good revenue growth elsewhere, these elevated multi-year costs for governance, for controls, they're just weighing so heavily on the U.S. profit outlook and therefore on overall investor confidence about the near term. It's a massive drain on resources.
That brings up a really important point about the future then. Current credit looks okay, but the bank's own forecast for PCLs seems cautious. They expect fiscal 2025 PCLs in the 45 to 55 basis points range. Is that just them being conservative, or is it a signal about the economy?
I think it's a very prudent signal. It's interesting because while performing PCLs, the reserves for loans currently okay but might sour are actually going down. They specifically added to performing reserves for other reasons. They now hold about U.S. $600 million, specifically earmarked for policy and trade uncertainty. Now that's interesting. They're anticipating potential hits from things like the USMCA renegotiations or maybe new tariffs on certain sectors. It shows forward-looking caution about credit quality, even while current impaired PCLs loans already in trouble are down. The key question for investors becomes, under what conditions might these specific reserves be released? Or will they actually need to use them? That could really impact future earnings down the line.
So it's not just today's credit, but bracing for potential future storms. And that restructuring program, they expect to see $600 to $700 million in charges over a few quarters. But it's aiming for $550 to $650 million in annual savings eventually. That seems absolutely critical, right? To offset those high AML costs and keep that positive operating leverage goal alive. It really paints a picture of a multi-quarter cleanup, a refocus. But executing on those savings, that's going to be a huge watch item for the market.
Precisely. The road back to sustainable growth, especially improving that U.S. retail profitability, really depends on a few things. Successfully navigating the AML fix, controlling those costs effectively, and crucially, getting a clear timeline for when that U.S. asset cap might be lifted. Remember, that cap limits their U.S. growth, and it's a regulatory decision, not directly in the bank's control. Investors are definitely going to want more clarity on all these points at the upcoming Investor Day. That's September 29th.
Okay, that brings us nicely to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea. based on everything we've just discussed. And just the usual reminder, folks, this is purely for discussion, for entertainment, not advice.
All right, so given the market's heavy skepticism right now, really focused on that AML overhang and those specific reserves for trade uncertainty, here's a thought. Consider a long-dated, out-of-the-money call option spread on TD shares, and you'd be targeting a potential breakout maybe late 2026, perhaps early 2027.
Late 2026, early 2027.
Yeah.
Okay, why that specific timing? And unpack long-dated, out-of-the-money call spread for us.
Sure. Long-dated just means the option contract expires far in the future, giving the whole turnaround story time to play out. It needs time. Out-of-the-money call means you're betting the stock price will rise significantly above where it is now. It costs less than betting on a smaller move, so it's higher risk, but potentially higher reward if that big catalyst hits. A spread involves buying one call option and selling another, usually to limit cost or risk. But let's keep it simple. The core idea is betting on a big future jump. Now, the timing late 2026, early 2027, that lines up with when the crucial sustainability and testing phase of the AML remediation might wrap up. The bet is this. If TD really nails the compliance, demonstrates sustained improvement earlier than the market currently expects, that could lead to the U.S. asset cap being lifted sooner than anticipated. That could be a major trigger for the stock to re-rate higher. And to make it a bit more sophisticated, maybe you'd pair that long TD call position with a short position in a Canadian peer bank, one that doesn't have the same U.S. issues or AML cloud. You're essentially betting TD underperforms its peers until this cleanup is demonstrably finished, and then it potentially outperforms sharply. It's definitely a play on a delayed but potentially powerful catalyst the market seems quite doubtful about right now.
Okay, so wrapping up this deep dive then, we're left with this really interesting picture. TD Bank Group delivered a Q3 2025 that was financially strong in many ways. Robust performance in Canada, wealth, wholesale, like a powerful engine running really well in parts. But that engine is also undergoing this incredibly complex, very expensive repair job, the ongoing U.S. AML remediation. And that, plus the careful buildup of reserves for trade uncertainty, continues to weigh on how the market sees the stock. And critically, it's hitting that U.S. retail profitability hard.
Indeed. Management sounds optimistic, pointing to the restructuring the AI investments as the path forward. But investors, they're going to stay laser-focused on execution. What happens with those AML costs? When might that asset cap realistically be resolved? And how does credit quality hold up, especially considering those unique trade-related reserves they built? The real question for you, listening, might be, how long is the market prepared to wait for that foundational rebuild in the U.S. to be truly complete? When will the full power of TD's engine be unleashed again?
It's definitely a test of TD's resilience and management's ability to execute on a complex strategy. We'll certainly be watching closely as they head towards that Investor Day on September 29th.
And always, always remember, the information we discuss here on Talk Tickers is for informational and entertainment purposes only. It should absolutely not be considered financial advice. You should always consult with a qualified financial professional before making any investment decisions. Seriously.
That's it for this deep dive. Thanks so much for joining us, and we look forward to bringing you more insights very soon.